Hey everyone, hope you're well. Thanks for joining me. My name's Ben, and today I wanted to go over a method we can use to potentially find the intrinsic value of a company. This is a good method to use for stable growth companies as opposed to rapid growth companies. So do stick around and we can make sure that we know that we're buying companies at good value and not losing money on our investments. Now, the formula that we're going to be going over, I believe, was originally provided by Phil Town. We are going to be going over an example, in this case Microsoft, and I will be using a calculator in this, and I will endeavour to include it in the description down below, so feel free to check that out. So what elements are actually needed for the calculation? The first thing we'd be looking at is the company's EPS from the last year, followed by the company's expected year-on-year growth for the company. Then we would be looking for our required rate of return and also the company's PE ratio. Additionally, we could look to add in the extra value of margin of safety, which we will do on this calculation. Now, all of these figures can be relatively easy to find or work out. If you're interested in looking at how to work out the PE ratio or EPS, or you're new to them entirely, I have made a couple of videos which I've linked down in the description, so feel free to check them out. However, if you're not looking to make it yourself, you can find this information from resources like Yahoo Finance. The intention of this formula is to work out the future earnings per share on the company based on the growth rate that we've given. Once we have this estimated earnings, we can use the estimated price to earnings ratio to generate the potential future price of the stock. Then, by working this backwards using our required rate of return, we come to the price that in theory will allow us to gain our total return that we've required based on the future sale price and the current price we're buying at. So for our example here, we're going to use Microsoft. If we jump over to Yahoo Finance or a similar online platform, we can see that Microsoft have a current PE ratio of 34.88 and an EPS of 6.71. So we simply take these figures and we pop them into the calculator. Next, we would want the estimated growth rate of the company. This one's relatively personal and subjective, depends on your understanding of the company, the business and the finances, and where you think they're going to go over the next 10 years. However, in this case, Microsoft is a relatively large company, and we're going to look for other analyst reports to get our guide on where we believe it's going to go. So looking over to Yahoo Finance, we can see that the next 5-year estimated annual growth rate for the company is around 16%. So we'll assume this is close to the correct figure and use that. Naturally, if you wanted to be a bit more on the conservative and cautious side, you could always reduce this figure. Then we have to work out the rate of return that we want to get. And again, this one is relatively subjective and based on what you want to see out of your particular investment. However, on this occasion, I'm going to use 15% to keep it simple, which is a relatively medium to high rate of return. So now we have these two figures, we can pop them into the calculator and we should get a final score spat out. What this is actually doing is using the earnings per share and the growth rate that we've provided to work out the future earnings per share. If we wanted to do this manually, what we'd be doing is looking to add the 16% growth rate each year to the original company's EPS. And in this case, if we did it manually, it would show that the future EPS is 25.5. Now we come to the P ratio. And the reason that the P ratio comes into play is we've worked out what the estimated earnings of the company are in the next 10 years. But we want to know what investors are likely to pay for those earnings in the next 10 years. To do this, we simply take the 10-year EPS value and times it by the PE ratio. This would show that the 10-year value of Microsoft is sitting at around $890, which means that if everything went as planned and they grew 16% every year, you could sell your shares in 10 years for $890. But what we want to know is, what is the price we should be paying for the company right now? And also, have we smashed the like button or not? So to come to a price that we're willing to pay right now, what we want to do is essentially undo everything we've just done, but make sure that our rate of return is included into that. So the formula to do this would be the future share price divided by 1 plus the required rate of return. If we do this to Microsoft, it shows that Microsoft expected value is currently $253 per share. Now, that's all well and good, but we can't guarantee that everything's going to go as expected over the next 10 years. We can't guarantee that the company is going to grow at the 16% that we've estimated, and we also can't guarantee that future investors are going to be willing to pay the same price per earnings ratio that we've looked at now. So there are a couple ways we can mitigate this. The first one would be to use the margin of safety, which is essentially a buffer in case the company doesn't do as well in the future. This number could be completely down to you, anything that you really want. A lot of people seem to recommend either 25 or 50%. So for today, I will use 50% for ease. This leaves us with Microsoft as a final value of $126, which is currently below their trading value, as I believe they're trading at around $230 to $250 at the moment. So as I mentioned, I will be trying to put the link to the calculator I've just shown down in the description below for you to use on any companies or stocks you may be looking to invest in. Just remember that generally it works best on stable growth companies as opposed to rapid growth companies. And it's always best to use multiple methods and evaluation techniques when looking at an investment. If you are interested in another way of looking at stocks, I have got a video here around potentially evaluating a dividend company. So feel free to check that out. And until next time, remember to invest, save, and subscribe.